Hello and welcome to SBUX Academy. In this video, I will make an in-depth stock fundamental analysis of the company Starbucks. I will cover its history, business model, revenue and growth, profitability, balance sheet, valuation, and finally do the 3M analysis. So make sure to watch till the end of the video. Starbucks was founded in 1971, 53 years ago. Its headquarters is in Seattle, Washington. Starbucks has 381,000 employees worldwide. The company has a $92 billion market cap. Its stock is trading around $82 at the time I'm making this video. Starbucks is probably the most famous coffee chain in the world, with more than 21,500 stores in 64 countries. Starbucks makes money by selling coffee, tea, food, and other ready-to-drink beverages in its company-operated or licensed store. Other revenues also come from royalty and licensing incoming, consumer packaged goods, food service, etc. Since Starbucks products can be found in grocery stores, convenience chains, and other beverage selling places. 74% of the company's revenue comes from the selling beverages, especially coffee. 22% from selling food like cookies and cakes. Starbucks is not the only company offering coffee. It has a lot of competitors. However, it has the highest market share among them. Starbucks grew its revenue from $16.4 billion in 2014 to $35.9 billion in 2023, a 2.18x increase in 10 years, which is an 8% compound annual rate. This is really good. Now let's check the profitability of the company. The gross profit is the result of revenue minus the direct cost to create these revenues. The gross profit margin is the result of gross profit divided by the revenue. The gross profit margin shows the amount of profit made before deducting selling, general and administrative costs, which is the firm net profit margin. The gray line in the chart represents the gross profit margin over the years. It is clear that the gross profit margin is decreasing with the revenue. It decreased from 31% in 2015 to 27% in 2023, which means the costs of production are increasing with the revenue, something I don't like to see as an investor. Next, let's check the operating profit and the operating profit margin. Operating profit is the net income derived from a company's core operation. It is the amount of money that a company has left over after meeting its operating costs but before paying its taxes. Starbucks is a profitable company. In 2023, it made $5.5 billion operating profit. However, the operating margin is decreasing. It decreased from 17 to 15%. This is again something I don't like to see as an investor. The reason is Starbucks is a high capex business. It is expensive to open new stores, buy the equipment and hire and train the employees. Furthermore, we are facing inflation and Starbucks cannot increase the price of their coffee relative to the high inflation we have. Now let's have a look at the free cash flow. Starbucks is free cash flow positive, which is good. As you can see in the chart, the free cash flow is all over the place. The reason is that Starbucks is a high capex business. The company invests its cash to open new stores every year. This is the reason why the free cash flow is far below the operating expenses and fluctuates so much. Now let's check the efficiency of the company. In other words, analyze the operating cost. The cost for SG&A, which means sales, general and administrative costs, are $4.34 billion. The costs are increasing every year. However, their percentage of the revenue have decreased in 2022 and 2023, which means the company have a good operating leverage and is getting more efficient. Now let's have a quick look at the balance sheet. Starbucks has a $6.46 billion in current assets. The current assets are the assets that are liquid and available to the company within 1 year. They include cash and short-term investment. The total current liabilities are the liabilities which the company must pay within 1 year. Starbucks' total current liabilities are $7.52 billion. Starbucks' total liabilities, including long-term debt, are $37.8 billion. The long-term debt is $15.54 billion. Considering a free cash flow of $3.6 billion every year, the company needs 4.3 years to pay its debt. So it is clear that the balance sheet is leveraged. The growth of the company is due to the debt it has. Starbucks also pays dividend every year. Let's check the debt maturities to see if the dividend is safe or not. Starbucks must pay $1.8 billion in 2024, $1.25 billion in 2025. This is almost half of the free cash flow, so the dividend will be safe. However, Starbucks will not have enough cash to reinvest in the company and grow organically. If they pay the dividend, they must finance the growth with further debt, which is something I don't like to see as an investor. Now let's jump to valuations. Starbucks has a 2.56 price to sales ratio, a 22.48 PE ratio, a 12.51 price to free cash flow ratio, and a 2.4 PEG ratio. Pause the video and check how the current ratios compare to previous years. For a company with an 8% growth every year, the valuations are not cheap. Now let's do a discounted cash flow analysis to determine the fair price and intrinsic value of the stock. This is how my model works. I calculate the worst case scenario to determine the downsides, a normal case and best case scenario. The first column represents the growth rate for the next 5 years. The second column represents the growth rate for the 5 years afterward. The third column represents the terminal multiple or the PE multiple at which the stock will be sold in 10 years. The fourth column represents the discount rate or the rate of return the stock will grow over the years. Considering an 8% growth for the first 5 years, a 5% the 5 years afterward, a terminal multiple of 9 and 15% discount rate. The intrinsic value of the stock is $34.9. Starbucks is trading at $82, which is more than double the intrinsic value. Finally, let's do the 3M analysis. 1M for moat, 1M for management, and 1M for margin of safety. Starbucks does not have a strong moat. It is one of many coffee suppliers and faces new competition every day. It does have a strong brand, however, I would not consider it as a strong moat. Management have done an okay job. The company grew, however, using a lot of debt. What is good is that they did a lot of shares buybacks. However, at this premium price, I would prefer if they invest the money in growing the company instead of buying those expensive shares. For the margin of safety, the price is very expensive and the balance sheet is loaded with debt. Starbucks is owned by some value investors. Pause the video and check who they are. However, it is clear that Starbucks is not a high position in their portfolio. The highest portion of Starbucks in their portfolio is 3.37%. for Jensen Investment Management. Now let's see what analysts have to say about the stock. The average analyst price of the stock is $88.98, which is higher than the current price of $82. Most analysts consider the stock a strong buy or buy. In conclusion, Starbucks is a good company. It has an 8% growth rate every year, pays a small dividend. The balance sheet is loaded with debt, however manageable debt, nothing crazy. I don't like to see the company paying dividends when it has so much debt. It should use the cash to pay back its debt before buying shares or issuing dividends. The company have an okay moat due to its brand. It is an okay company. I personally search for great companies with a strong moat that can grow organically without the use of debt. So I will pass on this one. I will not invest in Starbucks. Let me know in the comment section below the video what you think of Starbucks and if you will buy the company. If you found value in this video, please give us a like. This helps a lot and consider subscribing. Thank you very much for watching.